for us, we're sort of frothing at the mouth a little bit as a bond manager because you can harvest these really attractive single-digit total returns without reaching for either credit risk or interest rate risk. So I would argue that the bond market is, over the last 10 years now, relative to, today, the market today is very attractive for a bond buyer.
Hello, you're watching Proactive. Joining me in the studio today is Sean Dranfield. He's the CEO of PT Asset Management. Sean, very good to have you back in the studio. We're talking about bonds. So let's start with the Iran conflict and now the ceasefire. How's that changed interest rate expectations and credit spreads? And what are you seeing post-truce?
Yeah, so it's quite interesting. So you'd expect to have had a lot of volatility in the bond market as a result of what's going on in Iran, but surprisingly, it's been fairly muted. And if anything, we've had a slight rates up movement year to date, but it's been very, very modest across the entire curve. And equally, that's true of spreads. Spreads were, beginning of the year, at all-time historic tights. They gapped out a little bit, but as a result of the crisis, they sort of have gapped out and come back in a little bit. But all in all, net-net, there's been a fairly modest move in both credit spreads and interest rates. For us, it's a great example to us, and I know, Stephen, we've talked about this before, of the inability of anybody to predict, right, rates or spreads. Despite the fact that if you talk to people at the beginning of the year, particularly in the US, people were saying, oh, I expect rates to go down. Trump's, trying to drive down short-term rates. And in fact, we've had a small upward movement in rates year to date, which is clearly inconsistent with what people were predicting. But the impact of Iran has been very, very muted on bond markets overall.
I mean, with inflation, with geopolitics driving inflation and rates and uncertainty, are we now firmly in a higher for longer scenario? And how does your shape management strategy adjust for this?
Yeah. So you would expect, if that was the belief in bond markets, you would expect particularly the longer end of the curve to have an upward movement in rates to compensate for this expectation of inflation. And in fact, we've had no movement at the long end of the curve. So what's happened is, so at the long end of the curve, you've got like fairly high rates now, but you've also got a ton of steepness in the yield curve. And so if you think about bonds, if I just pick on treasuries, and I think gilts are the same as well, treasuries are issued at par. So the coupon is the same as the yield on the bond when it's issued. So the really interesting thing about the long end of the curve is they have this, big head start in terms of income, and you've got a lot of steepness to the curve, which makes those bonds very attractive, because over time, if a bond rolls down a steep yield curve, its price is going to go up fairly dramatically. So shape management tells us for the first time in a long time to actually go quite long. So we're buying sort of 20-year treasuries, 20-year taxable municipal bonds, who have very attractive rates down go forward total returns. And as you know, we don't predict rates, so we're going to always combine those with shorter, more defensive bonds, but those bonds are really attractive from a mathematical perspective right now. And you only need a very small, modest downward movement in rates to create a double-digit return for a long treasury right now, which is remarkable, right? Because you'd expect that from an equity.
I mean, given rising deficits in the United States, are you still confident in the long end of the treasury curve?
So there's no doubt that the deficit is a problem, but I think the bond market is sort of sighing at that and hasn't reflected any concern as it relates to the deficit. Now, you could make the argument that the steepening in the yield curve has somewhat been a result of that concern about the longer term deficit, but year to date and certainly over the last several months, we've seen no upward pressure on rates as a result of the deficit. And again, like that total return math at the long end of the curve is very, very attractive right now.
Where are you seeing the most compelling opportunities in the bond markets right now, and what's being mispriced?
Yeah, so I would say I've talked about those two offensive opportunities. I think that on the shorter end of the curve, we're still very compelled by sort of very high quality structured credit bonds. So that might be CMBS, it might be CLOs, and we're typically talking about double and AAA bonds, but you can still get very attractive single digit returns in those bonds with little, if any, credit risk, and those bonds are interest rate insensitive. So rates move up, down, or sideways, you get no movement in total return. And it's a great 1-2 punch when you combine those with the long bonds that might help you if rates go down. So, you only have to, go back to 21, 22, where you had very low interest rates, right? For us, we're sort of frothing at the mouth a little bit as a bond manager because you can harvest these really attractive single-digit total returns without reaching for either credit risk or interest rate risk. So I would argue that the bond market is, over the last 10 years now, relative to, today, the market today is very attractive for a bond buyer. So we're actually quite excited about buying both offensive and defensive bonds today in light of the market.
Sean, if volatility returns, whether from geopolitics or from growth, how defensive is your portfolio today?
Yeah, so today, if I think about our UCITS fund, so the fund that's available in Europe, today it's just over 2/3 in defensive shape. So those are bonds whose total returns are insensitive to interest rates. And we're also hunting at the top of the capital structure, and they tend to be shorter bonds. So they're also not particularly credit spread sensitive. So we feel like we have a good portion of the portfolio invested in these high quality single digit rate and credit insensitive bonds. So a good buffer to protect us against volatility. And sometimes volatility creates opportunity. And surely if the math sort of points us to, a different sector or a different type of bond, we'll go after that math. But I feel like we're well positioned to protect against potential volatility.
Well, Sean, thank you very much for your insights as always, and thank you very much for coming in.
Thanks, Stephen. Appreciate the time.
Sean Dranfield is the CEO of PT Asset Management.